welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Joyce, managing director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. We'll also talk about the key data that's been coming out in the month of March. And Brian, this really has been the story for March, is all the macro that's going on. Of course, we had Powell speaking in front of Capitol Hill this week, JOLTS data yesterday, we have the jobs number tomorrow.
Sure.
A lot going on in the market.
Yeah, a lot going on. Really a lot's changed. We've spoken about this the last couple of times since that February 2nd date when we saw just stronger CPI data, inflationary data, and strong jobs. So jobs has been strong. The unemployment rate is low. In late Feb, we had the latest core PCE. I believe it's up like 4.75%. So, the market was anticipating this, second half pullback in rates. Maybe the Fed will start cutting rates by then, and that's really shifted noticeably since the beginning of February, and particularly in the last week or so.
Yeah, and we're going to get into that in just a moment, but I want to take a look at your first chart with the Nasdaq-100. Give us a look at some fresh technical levels to watch, because it seems as if it has been digesting what's happening with macro relatively well, or better than I thought it would have.
I would agree with that. So, all throughout this year, we've seen, a strong relief rally in those groups that had the biggest declines last year, technology, consumer discretionary, communications. And so while we've seen a lot of corrective price action over the last 5 or 6 weeks, I think the Nasdaq-100, it's definitely holding in pretty well. We're a day or so away from a golden cross. And we had this breakout in the early part of last month, in late Jan, early Feb, of this what looks like a double bottom pattern right here. And so we, in the process of retesting of the last 5 or 6 weeks, we bottomed a week ago, last Wednesday, I think, at the 200-day and 50-day moving average. And, we're seeing a pullback today. We're reversing lower today. A lot of other sectors, certainly could be more concerning. But I think right now, if you're looking on an absolute basis, just at the Nasdaq-100 on this daily period chart, I think, there's some, relatively good price action that we're seeing, not necessarily the last couple of days, but I think, over the last couple of months. So I think right now that has not yet been negated. If we zoom out a little bit, we could see on this weekly period chart a little bit cleaner look that we're simply still retesting the top of this double bottom zone here. And we did break out to the upside during this bottoming pattern, or this bottoming phase from this declining trend line all throughout 2022. So, it certainly doesn't mean we're out of the woods yet by any means, but I do think that at the moment, it's, I think, a little too early to get too concerning about certainly the Nasdaq-100.
I'm going to talk about the regional banks down 5% to the regional bank ETF. I'm sure Silvergate and what's happening with Silicon Valley Bank is lending to some concern with what we're seeing with the smaller banks.
Sure, yeah, and I think those issues today in particular are unique to those two banks. I think more broadly, there are some issues that the industry is facing. So when I came in and I saw the ETF today, or the index today, was down 4% and then 5% and then more than 6% just today alone, you dig a little deeper in the weeds. There's been some recent bank conferences going on, and some banks have been raising concerns about their deposit costs. So assumptions regarding those costs are going higher now, and so we're hearing that from just one or two banks. And the question is, I think maybe what the street maybe is looking ahead to is, will we begin to see more of that? Will more and more bank management teams come out and say, what, due to the rate environment going higher, and us being at these levels for longer with higher short-term rates, it just puts more pressure on banks to raise those deposit costs, and so that's going to be a direct hit to NII. So are we at peak NII for the cycle? Are we now rolling over? If you combine that with the oncoming credit cycle, and when is that going to hit? It just suggests all combined that maybe banks are in for some headwinds going forward.
I wonder if there's a little bit of liquidity risk or concerns out there as well. Because when you start to hear those things, this wasn't necessarily about crypto. This was more about a bank liquidating. Anytime you hear that word like liquidation or liquidity risk, I think that just spooks banks in general.
Absolutely. So any financial institution, those are kind of buzzwords that you don't want to hear anybody talking about, the media or people in the industry suggesting things like that. It's almost kind of like saying there's an accounting scandal. We don't know yet if there is, but let's invest. So those are, obviously those are tough words that no management team wants to hear being spoken about. But I think we're, a long ways away. from there being anything sort of systemic going on. There's always one or two banks or a handful of companies in any sector that can have their own individual issues. But as a whole, we know coming into this cycle, banks had good balance sheets. So you'll certainly see one or two banks may have to execute some maneuvers to maybe improve their capital ratios, given we had a dramatic decline last year in the rates market. So we saw a lot of bonds, even the Treasury bonds, had these record declines, and so that's going to impact banks. And some banks have different mix of securities in different sectors: mortgage, Treasuries, CRE. So it's not surprising that we're seeing now certain banks having to do things like sell securities to raise some capital in order to shore up that balance sheet. But I don't think there's anything close to being systemic that I think banks are being concerned about. But what's really kind of changed, what we've seen in the last 6 weeks, is that rate market. If I could flip to this yield curve here, where the blue line is the yield curve on February 1st, and here we go 6 weeks later, we could see the dramatic shift. The 2-year yield over the last 6 weeks is up over 80 basis points. So there's what we're seeing right now in the equity market. I think we're just, as you noted, that we're digesting all of this kind of, this new rate structure that's underway.
Yeah, it feels as if the equity market is starting to catch up with what the bond market has been telegraphing. We saw rates come in a bit in January, and then the rate at what they moved in February. And with Powell's testimony, it's not like he said much new, but there certainly wasn't any indication of easing back.
Yeah, no, I think they're concerned that the inflation numbers, the job numbers, they're getting firmer, they're getting stronger. So that's something that, the Fed, they were behind the curve in all of 2021. It took to late 21 when they dropped the word transitory, and then even from there, we waited another 4 or 5 months. 4 months. It wasn't until March where we saw the first rate hike. So they certainly weren't in a rush to raise rates. Then they jacked it up 75 bits with 75 bip rate hikes, 4 consecutive meetings from June through November, and then the last 2 meetings down 25 bips each meeting. So they raised it 50 bips, and then they raised it only 25 bips, and now we're talking about raising it back up 50 bips again. So I think we're going to see in the short term there could be this volatility. I think there's a lot of signs that a lot of different buckets within the inflation numbers are coming down meaningfully. I think it's housing that's really been holding those inflation numbers higher. Certainly, core services as well. Jobs numbers we know are strong. So, I think it's just this lag time from when we're seeing the onset of the rate hikes. And we saw the curve, the 10-year 3-month spread, which is a very key barometer to look at as far as recession. That only inverted, I think, in November. So if that's a 12 to 18-month lag, you can certainly, let's say 14 months, you can certainly argue that maybe there's a recession coming in the pipeline. It's still too early to say if it's going to be soft or hard, but this may not happen until late 23, early 24. And what can the equities do in the meantime between that? Can we go higher? We might be able to go higher until that happens.
Right, but Brian, if we think about it from a historical perspective, these rates are in line. I don't think we're ever going to go back, at least not in the near future, to the zero interest rate environment that was so easy to get used to, right? I mean, we're used to that liquidity and all this capital flushing around. I think it's going to be probably somewhere in between once they start to ease off of that. I don't think we're going to get back to what we got used to during the COVID era, if you will.
Yeah, I mean, we might. I would say let's hope so. I think it's healthy to have an interest rate environment instead of always being down at the zero bound. ZIRP was in place for the better part of the the last decade of the financial crisis. So an interest rate environment where we're off the zero bound, I think would be a good thing. But if we do have a credit cycle that comes down the pipeline, which I at some point expect we do, we'll see how severe that is, and we'll see how the Fed reacts to that.
All right. Appreciate
we also have QT involved as well.
Yes, we haven't even started with that yet. We have not started with that. All right. Appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.